welcome you all for this webinar on taxation session. You all know Chennai chapter PSG Association is doing a lot of webinar like this, and also a lot of physical activities. Even last month we had a family get together, and then next week itself we have a walkathon session. Likewise, several monthly initiatives programs are being conducted. Today we have another session called taxation session. We have our beloved alumni speaker Subhaya sir is going to give a lecture on taxation session. Reserve all your questions at the end. We will all take your questions at the end. Request in between questions we request to avoid. And to just to give an introduction about our today's speaker, our Subhaya sir, 88 batch textile engineering, and he also did his master's in financial management from Mumbai University. He joined as a senior marketing manager at Indorama Synthetics, and then later on he worked as a IFBA, as a corporate trainer. And then last 17 years he is running a company called Adapt Assets, wherein he does several finance related initiatives, including portfolio management services, mutual funds, insurance, broking, training, banking related activities, tax planning. So all these financial related, that is his passion. He's doing it as Adapt Assets. He is also a certified financial planner. He also did several certification courses, NSIM certification courses. He is also a SEBI registered analyst. So we are very happy to have him as a today's speaker. We also have done 4 webinar sessions on personal finances. You might have seen his attended his sessions and the recordings as well. We are once again to have him in this session. Thank you so much, sir, for kindly accepting our invite and dedicating your time despite your busy schedule. Over to you, Subhaya, sir.
Great. Thank you so much, Shanmugam sir. You are always kind, giving more than what the speaker deserves. So thanks again for that. You said everything right except a small correction. I'm not a SEBI registered analyst, so I have to make the disclosure. But everything else, what you said is perfectly fine. As me, welcome you all. Let's have a session on taxation. We had, if you had attended my previous 4 sessions, we just took you through various tenets of investing. Here, the association wanted us to do a session on taxation, probably because we are at the taxation season. But what we are going to do today is not merely looked at from the taxation season point of view, but the idea is to take you over through the eye view of taxation, bird's eye view of taxation. So let me start my presentation. Let me share the screen. Please confirm, Chandru sir, if you're able to see it, you can confirm that. So I'm here sharing this. So if you just say, yeah, it's...
Yes, sir. Yes.
Great, sir. Thank you so much. So friends, happy to start. So, like I said, this is going to be a session which will talk broadly on various aspects of taxation. Some broad guidelines here. We are basically going to talk about, individuals taxation. We are not going to talk about company taxation or non-individuals for that matter, because it may not be relevant also here. Number 2, we will be discussing the concepts. Some of the concepts you might have covered, some of them you might have never come across. So we will discuss the concepts in more. But we will not be focusing on very finer aspects, because that will take a lot of time. And this also focuses on, it is actually centered around resident individuals. We are not speaking specifically about NRIs here. Of course, most of the taxation which arises in India out of income made in India, it is common for both, but there could be be some difference in NRI taxation in terms of withholding tax or global income, etc. We are not covering that. Fine, great. So let us start up. We are all working, we are all making money. Please understand, wherever income is going to be there, taxes are going to fall. So there is no way you can, try to avoid or escape or something like that. On the contrary, I am clearly of the opinion that you should be contributing to taxes because that helps the society. Oh, great. Now, if you look at anybody's income, broadly, they will come from these 4 categories under 51%. Most of us could be salaried. So, where do we have our income? We have our income from salaries. And luckier ones, those who have more properties to, put on rent, they have most property. Then the elite class, which runs businesses, who make profits and gains from business and profession. And then there are, the most lucky ones, I would call luckiest ones, who have only assets. They need to work, a lot of assets. They invest in assets, they gain in value, and you need to pay taxes on those gains, which are called capital gains. So salary we have, income from house property we have, profits and gains from business and profession, capital gains, or anything which doesn't fall in this is taken to the 5th category, which is income from other sources. Just an example, income from other sources, I think we will be seeing it. So, income tax doesn't leave any of it. If the income doesn't fall in the first 4, then obviously income will be included, which is income from other sources. Everything will be fine. Now, certain important things to remember from taxation. In some cases, it is not only per income, but some of the other persons become also included. Let's see the examples. You may have multiple sources of income. You may have salary, but you may also have income. So under different heads, you have to declare them, and finally you have to aggregate them and come up with total tax. The department gives you some benefits, like if you have losses in the sum rates, if you are unable to set it off in the current financial year, you are allowed to take it forward for setting off against future needs. Right? Then, out of the total taxable income, the government is kind enough to give you some deductions to be made from the total taxable income. You will reduce them accordingly with income and pay taxes. Then you have some sort of debates and claims, we see them. And some income are exempt also. Say, for example, some kind of agriculture. And there is a concept of advance taxes. Anybody who is is supposed to pay advance taxes. So first we saw the different kinds of income which a person can make. Now we just saw some of the important points before we proceed with their taxation calculations. So you know these tax rates. I don't need to repeat this. Several tax rates, 60 years taxes at age above 80 years need not pay the taxes up to 5 years. So this is, in current parlance, old tax rates. Old means still existing. Now, let's look at the surcharge. Those who make higher incomes up to 50 lakhs, there is no surcharge. 50 to 1 crore, you don't have to pay 10% surcharge. 1 to 2, it is 15%, 2 to 5%, 25%, and 5 crores is 37%. So if you have this income, basic slabs, and then according to these slabs, you may have to pay surcharge. Now, government recently had this new tax rates. For FY 23-24, we have this. Up to 3, nothing. Then every 3 lakh increase. The tax increases by 5%. If you look at this, you will see 3 to 6, 6 to 9, 9 to 12, 12 to 15, 15. Here 5 mil, 5, 10, 15, 20. Sorry, with cap to 10, yeah, it's going up by 5% up to the 15 lakh step, and then it will jump into the 30%. So, this you have to keep in mind. To my mind, salaried class are allowed to shift between these two as and when they want, but business classes have restrictions in terms of design. Now, some of the income need not be included in the total income, not because they want to be denied, but because it would have been already taxed in some cases. Say, for example, share of income on particular venture. Or if somebody is a partner in a partnership of the firm, paid the taxes, and after that they were paid something to the partner. So the partner, while he pays his income tax, personal note, he and some very different examples, NRE account. All residents will have NRE account. They invest, they deposit money there. So they need not pay taxes. And something like a Sukanya Samriddhi scheme, from where get the cash flows, that is also expensive. So some of these scholarships are also expensive. Just a small change, Shanmugan sir, Natarajan sir, am I audible? Because I'm unable to see my own picture. That means that will make some sort of control of what I'm trying to say. Can you please continue? Audible. So these are some examples. See, in 1 hour, we cannot do an exhaustive program on taxation. If you look at any of the books, say, for example, Mr. Manoharan's book, which is generally given to CA the students on taxation, income tax and GST put together are quite close to 1,000 pages. What we are trying to do is do something in 1 hour, whereas that particular subject people do for 6 months and still they are unable to have clarity. So what I'm trying to do here is, at least at the end of the session, you should get out of your chair having a clear inside view of a taxation. Then you can have some questions for which I'm always available at the end of the session. I'll give my mobile number and email ID. So you can always get in touch and get better. So now you remember we talked about various heads of income. This is how income tax defined the various heads of income. Like I repeat, salaries, income from property, profits and gain from business and profession, capital gains, income from other sources. There could be somebody who's got income under only one of the head, whereas there could be somebody who's got income under all the heads. Say, for example, somebody is employed, he will have income from salary, he's got one house put on rent other than the set of so that income will come on them. After that, he might even do a part-time business or profession, whatever it is. For example, a doctor might be salaried in some hospital at the same time he does practice. He may also have a couple of homes to not rent. And also he should be investing in mutual funds and stocks. So he's got all the income. On top of it, he might be putting some deposits in the bank for which he will be receiving interest. That will come to income. So any of us can have income from all the above methods. That is why in the earlier slide we saw aggregation. We need to aggregate and each and the other. So if you are going to ask, I say 2 lakh rupees is the rent that we see. 30% of that, which is 60,000 rupees, I'm eligible for deduction other than the fact so that is 2 lakh 40,000. Now, if I pay 2 lakh rupees as interest, what becomes to my income? There is no income, there is a loss. So you can report a loss from the set of provisions which you can use. that last set. So that's a good thing if you are paying interest. Great. Now this is not only for house property. As an individual, if you are renting shops, grounds, or offices, that will also be coming. Don't mistake, it is mentioned as outside. Anything, any real estate which you are renting. So I hope so far it's clear. We had covered. But the doctor is also running a profession. So he will have all the 360 days of consulting about aggregating this. If you are using some machineries, say some scanning machine or whatever it is eligible to get reduce those expenses related to building a plant machinery, particularly in the form of depreciation. Or he might have borrowed, say, 50 lakh rupees to set up a hospital. He is allowed to reduce the interest on those capital also. He might be selling to people, he might be using cars. So the list is very long. All those genuine expenses which is incurred in running the business can be reduced from the gross income. That's it. So we are not going to see beyond this because this chapter is very big. So there are many deductions of it. For our discussion, this is a very interesting one. We are having the fourth one. Let me check the money also. So the fourth one is capital gains. The important thing is, are you holding a capital asset? If you are holding a capital asset, are you selling it at some point of time, which is called transfer? There has to be a transfer capital asset for which you should receive some consideration, meaning some price. So when you transfer a capital asset, sell a capital asset, receive some money.
Hello.
You will also have your
sir, greetings, sir. Your from Oculus. Regarding the PSG webinar, we contacted a team member.
This is how capital gains are calculated. Very simply. But
okay, sir. Please, sir, are you having any problems with getting it?
Ways of calculating capital. I'll take one small example.
Okay.
Some exemptions are also allowed in the case of capital. So let us see one example.
Yeah, sure. At the end of the meeting, the message will be stored. To the end of the meeting, you can again raise your hand and ask the questions.
Are broadly classified.
Thank you.
Long-term capital gain, short. What is long and short? They are defined based on the period you held these assets in your what of home 5 years before. What's up gold last year, you sold it. What a share day before yesterday, you sold it. So all the three asset classes different time periods. So different asset classes based on different time periods is classified either that is sold at month or sold short. I'll give you some. If you buy any equity shares to exchange, keep it for more than 1 year, then if you sell it, that qualifies. Similarly, equity oriented, there are other things we are not talking about. The whole thing, the more than 1 year, they also qualifies. Why I say qualify? Because they have better transaction. So there are certain types of mutual funds, hybrid mutual funds, which taxation changed last year, but still some funds are eligible. If they are sold after 3 years, they become long. If it is an unlisted share sold, that is minimum 2 years of investing. That is long-term investing. Same with the case with now. Assume you had those assets and sold. And for example, if it is an equity or equity mutual fund, I said, what is the long-term period for it? It was you bought something for 100 rupees. Maintain, say you bought something for 5 lakh waited for, say, 1 year, then sold it at 5 lakh 80,000. Now, here is the thing exemption I was talking. You made a gain of 80,000 rupees, but in case of equity and equity movements, there is eligibility for exempting up to 1 lakh rupees of capital gain per year. So, in the current case, which we discussed, 5 lakh sold at 5 lakh 80,000. So, 80,000 is the total gain, which will not be taxed because you are able to get cost qualification. Assume you sold it for 7 lakh rupees.
No.
Got 2 lakh capital gains. You have 1 lakh exemption. Minus the balance 1 lakh you will be taxed. This is what we call as differentiated or beneficial transaction. Now, just to put it in context, why we discuss long-term and short-term with the tax rates vary. For the same stock you sold before 1 year, then there will be tax. So this is one startup. Let's move completely different. Assume you sold a real estate. I said 2 years is here the taxation is different. But you got a benefit of taxation. I explained this to an example. Now, real estate you got a room 10 years ago. Sold it now at a particular date, say at 3 crores. So what is the capital gain? Generally, you might say 2 crores, 3 minus 1. But that is not the case. All these years, inflation was there. So even 1 crore purchase value will be inflated through the cost of inflation index released by the government. Then 1 crore has to pay fixed tax. We see that no example. I'll say this. Assume you got a property 2001, 2002, sold that at 2014. Generally, what you would say, my capital gain is 2 crores, paid 20% taxation. That is cost inflation index was founded in 2000. The cost inflation index is 14. So, you are eligible to get the 1 crore investment inflated to the indexed value as on 2014. So, your 1 crore investment by inflation itself would have become 1 crore. Now you sold that at 3 crores. So, after indexation, what is your capital gain? It is 3 minus 2.4, which is only 60 lakhs, not what you call it. So you pay taxes only on this 60 lakhs, which is 20% of it. So 12 lakhs. So this is what independence. So far, so good. Natarajan sir, Shanmugam sir.
Yes, sir. Fine.
Thank you.
Okay. Now, some exemptions from computing capital gains. Again, very large subject, but let me try to keep it very short. Same thing with right government gives you some escape, rather than escape, some relief from paying capital gains, provided you don't sell it. Say, for example, if you sold a house, whatever capital gain comes, you need to pay taxes. But if you reinvest them in a new residential house, then the capital gain is exempt. Conditions. Conditions. This is section 50. Now, other than the house, you had some agricultural land, which is not rural agricultural land, but not a capital asset and they are tax. So, urban land you sold, again you got a provision. If you invest in land, you invest the means back. You get Any other long-term capital other than a residential or sell them. And you put the entire sale proceeds, not only the capital gains, entire into buying a residential house. Then you get the entire capital. But there are again conditions. You should not have sometime time. Get all these stuff. So none of you want to buy another property or selling. You want to do something selling. This section 52 is whatever gains you have got. If you are planning not to buy more, but you are not interested. But if you invest in some specific bonds, they are your gains are exempt from taxation. Some of the bonds are REC, then you have National Highways Authority of India. REC stands for Rural Electrification Corporation, PFC Power Finance Corporation, and ARC Indian Railways Corporation. So if you invest in those bonds, they will have a lock-in of 5 years. They also pay lower interest, which is 5.25%, but you don't pay taxes on real estate sales. So these are the exemptions which are available for capital gains if you sell in your property. Now, let me go back here again. Say, take the case section 54, sale of residential house. What are you supposed to do for availing the tax exemption? You have to invest in the new house. Buying a house is not buying a sandwich, something like that. You need to look around, negotiate. Maybe the house is not really good, you like it. So what the government is saying, you have to buy the house within a certain period of you sell it. It can be even earlier also, sell. And it also says, if the house is under construction, then you can finish the construction within a 3 years you can complete it. So this provision is given. But what happens in actual practice? You sold this in the month of January, house. You want to construct a new house for which 3 years is given. But you have to file the return by say July 31st. Now the government should know whether you are going for a house or you are going to pay taxes. You might say, I am going for a house. Then the government is saying, so I want to put a catch. If you are not going to buy the home before you file it, or you paid for the whichever is early, then you have that a particular capital gain. Any bank schemes form. This is my proceeds from capital gains. I it is a bank deposit. Savings account also it can. But you should be careful because it has to be only used for the purpose of buying. The money will get transferred to the seller. For some reason you don't want that, you want to come out of it, then you have to pay all the taxes which you did not pay along. So be careful. So this scheme is available. That's what I wanted to bring to your notice. Now, what is left with now? We saw all the 4 categories. Now, what is left is income from other sources. Some of the examples are really different to get from stock or mutual funds. If you bought a lottery, luckily you won the huge amount or whatever amount. That is other sources. Horse races. The money you receive under life insurance policies, maturity policies. The family pensions, interest on securities, like NCD, whatever it is, interest on bank deposits, gifts you receive, right? So all have to be included in the income from other sources, and you have to aggregate that. The gifts I don't know how many of you all give gifts and receive gifts. There is a taxation. Let us have a look at it. Income tax is defined certain specified relatives. Other spend time, that's if anyone receives gift from the specified relatives, then they are taxed. And also, any gift received on the occasion of the marriage, receive gifts from all these governments, they're also not taxed. So what happens to a non-relative if you receive gift from them? If you receive gifts from non-relatives, an amount up to rupees 50,000 is exempt. But if it is more than 50,000, then the entire amount right from zero is getting taxed. Say you receive only 49,500, no tax. But some of your enemy came and gave you 20,000 rupees gift. Then the entire 68,000 is taxed. So this is what this is all. How many of you know clubbing commissions? People invest, people think investment things. He receives his salary, spouse, and so he smartly thinks, I'll transfer 20 lakhs to my spouse and she will make income. Because she doesn't have income tax, whatever that will be the lower slab. But government is much more smarter than us. What they say is, you can gift. But if you give to your spouse invests, the income out of that investment will be clubbed with it. So if you put 5 lakh rupees deposit in the spouse's name, who has no taxes, and she gets 8% interest rate, 40,000 income that comes will be added to her income. Similarly, people invest in the new products. That will also be clubbed to the parents' income, whose income is higher. There are some specific cases where minors are making money because of their own capabilities, their own skills. That is it. I hope that's fine. So what we see so far is we saw all the 5 categories. At the final from other sources we picked up gifts. We checked that also. Because of gifting, any clubbing provisions will get attracted. That also gives us. Now, I'm picking these points because they are relevant to us. People generally think because we saw this, just check this slide. Here, any sum received under life insurance policies, they generally get taxed. This is what everyone understood. But then there have been some changes of late last 2 years. It is exempt, but if it is adhering to some of the conditions. This condition is not a specified percentage, it's specified. So let us briefly check it. Assume, what I put as policy issue date, 2 periods, and does not exceed. Forget the first, let us go to the latest one, or after 1/4/2005. Any policy which you buy, on which if you pay premium more than 10%, then the tax exemption will not be applicable. So put it in a different way, assume you buy a policy, say with the capital sum assured of 10 lakhs. Then your premium should not be more than 1 lakh. If you pay 2 lakhs premium and get only a capital sum assured of 10 lakhs, then the amount of proceeds you get from maturity is not totally tax exempt, some of them will be taxed. So this is on specified percentage criteria. Let us move to specified sum criteria. There you have two things. See, these things may be little difficult, but these are important. That is why I bring it. So even if it is difficult, right ones. And when you buy a policy, please take these things into consideration. There are two types of policy. One is conventional product, the other one is insurance. If you pay premium exceeding 5 lakh rupees, then the exemption proceeds to be taxed. Method is, if it is a unit policy, then it is 2.5 lakhs. If you invest more than that, take it, the full exemption will not be applicable. 32, 830, they will be taxed. Policies other than ULIPs will be taxed. How? Whatever maturity amount you get, minus the premiums paid so far, balance amount will be added to the other total taxed. But in case of ULIPs, that will be separated in cost price and the capital gains. So capital gains will apply because the equity fund inside it, the capital gains will apply as it is. So there is now I said something called set up or carry forward losses. You have long-term capital gain, short-term capital gain, long-term capital gain, short-term. First thing is, within that, say you have two houses, one is giving blessing, the other one is giving points. So within the source is second. Then you have 5 different heads. One head is showing salary plus, the other one is showing income is plus, the other one is negative. So there also are provisions for setting them. But not everything can be set up against everything else. You have to even I have to one is now after setting it off, finally you arrive at the number per which you pay taxes per annum. Now, say for example, unutilized losses, or say current year you sold some share X long term. There is a say 5 lakh rupees of loss. You bought it for 10 lakhs, you sold it for 5 lakhs. 5 lakhs capital. First you need to check whether any other capital gain I have long term capital. Selling this loss can be set up against this. Assume you have 5 lakh rupees loss, but 2 lakh rupees only gain. So you can set it up, no taxes. Balance 3 lakhs you have. What will you do? The government say you can carry this next year. The condition is you have to buy from before the let it after that is now people ask, I have a short-term capital loss, I have a long-term capital loss, can I adjust against what? Very simply, if it is a short-term capital loss, it can be set up against both short-term capital gain and the long-term capital gain. If it is a long-term capital loss, it can only be set up against long-term capital loss. So, if you have a short-term capital loss in equity, then you have a long-term capital gain in a bond or residential property. That loss can be set up against your long-term capital gain also. But you have a long-term capital loss, say in a house property, you bought it from a group and sold it for 8 years. Because of indexation that can happen, even though you are actually not losing anything, but if the inflation is anything that's possible, you can put the capital. If it is a long-term capital loss, and you have a short-term capital gain, you cannot set it up. You have to look for long-term capital gain, either in shares or some other property or gold. Then you can set it up for the current year. But if you are unable to do it, there is no long-term capital gain for you to be setting it off. You can carry them forward for next year. People are using, if I have some capital loss, some 2 years before, which I am trying to set it off against future. So, hope you got this point. So, income tax is a vast subject, but I am taking something which we have to, be aware for our day-to-day uses. Not that all those provisions which we will never be using. This is, everyone is aware of this chapter. Chapter 6 saving. This is where you get all the deductions listed, which if you invest and spend, you will have your total taxable gets reduced, therefore your tax reduces. So please understand that's the difference between exemption and deduction. Exemption, like your insurance proceeds, totally exempt under deductions. But deduction, you will have your total gross income calculated, but before paying taxes, you can reduce by availing those deductions, for which chapter 6 provides the cut. Now, where you can invest under section 80C, under chapter 6A, you will have certain eligible investments, list of investments, and if you invest in them or spend on them, you will have those amount reduced from your tax. But then this limit is restricted up to 1 lakh. So if you invest 10 lakh rupees here, you will not get 10 lakhs deduction, you will get only 1 lakh 50,000. So most of them will not have insurance premiums. Home loan interest portion we saw in the income under house property, where you can set up an interest portion. The principal portion you can use it under section 80C. Tuition fee you pay for your children, Sukhanya scheme investments, mutual funds if you have, if you are putting SIP or lump sum in ELSS, you have that benefit. Term deposits of 5 years, that will be exempted. Senior citizen savings scheme, not exempted, you will have deduction. Right. So this is on section 80C. Now, something which is happening in the last 3-4 years, which is catching up is the NPS. I generally say my clients that if you are having a lot of taxable portions, most of the allowances are taxable. When I say them, ask your employer, to structure this in such a way that he takes out some of the allowances and in place of that he contributes towards your engagement. Right? That gets exempted. We'll see that. So there is a section called 80CCD, in which if you pay 10% of your salary towards NPS, you get that as reduced. But then this is part of section 80CCD, 1,50,000. So that is nothing, no big deal on it. What is the big deal here? Government has given one additional window for it. Other than 1,50,000 rupees, if you contribute separately from your account up to rupees 50,000, you can invest more, but the deduction is available only up to 50,000 rupees. Under this section, you will have an additional deduction of 50,000. So, section 80C 1,50,000, this NPS 50,000 if you invest, so you can get a total of 2 lakh rupees as deduction. Now, let me come back to the salary restructuring part. Up to 10% of your salary, tell your employer that you remove those allowances which are NPS taxable, pay them in lieu of that to my NPS account. So in that case, that contribution is not taxable. They get reduced. It is a government employee, then that can go up to 40%. So this is on NPS. One more important thing is your section 80D, which talks about the premium paid towards health insurance. The general deduction is 25,000 rupees per net individual. Right? Every one of us understands what is the health insurance. So up to 25,000 rupees you get a deduction. If you pay premium up to 25,000 rupees or whatever premium up to 25,000 you will get deductions. Now, if the person who is paying the premium for himself and his family is a senior citizen, then that 25,000 rupees gets enhanced up to 50,000 rupees. Right? So the person can take up to 50,000 rupees deduction. Now, assume the same person is not a senior citizen, gets deduction of 25,000 rupees, but also pays the premium for the health of his parents. If they are not senior citizens, we will get additional 25%. So 25%. If he is not a senior citizen, but parents are senior citizens, he can get up to 50,000 for parents. So 25 plus 50, 70. Now the fourth case, if he himself is a senior citizen, he also pays for the parents who are senior citizens again, then he can get 50,000 plus 50,000, which is 1 lakh rupees deduction from his gross total income. Now many people do not know this smaller. Even if you don't have a premium going for you, you are allowed to get an exemption up to 5,000 rupees if you are doing some preventive health checkups. So you can just check, every one of us must be doing some sort of preventive health checks. So when you file your returns, make sure you have the bills and use it. Other than this, there are some sections, 80DD, 80DD, and 80U, where if a person himself is under some medical conditions, or some of his dependent is under some conditions, so there are some reductions available. The amounts we need to check all those sections. So I'm just bringing those two points. So that was on section 80B. Now, most of us, either we ourselves undergo higher education or send children to higher education. So, here, if you take a loan and you start paying interest, and then you get deduction, whatever amount you pay for that initial assessment year, you get deduction. And you can go on like this for the immediately succeeding 7 months, whatever interest you pay. So, that is section 80E. Now section 80G, again, very, very large section where a lot of conditions put. If you donate to certain funds of charitable institutions, you get some deductions. But depending on the donation types, how much deduction you will get, there are certain institutions for whom if you give, you will get 100% reduction of whatever you give without any. Some institutions will qualify for 50% reduction without any. Now the third category, 100% reduction of the restricted amount. I mean restricted amount, there is a calculation. It's income minus chapter 16 reductions minus your short-term amount of capital. Whatever amount that comes, that will be the restricted amount. And 100% of that you can get provided to pay that much amount towards the donation. And the fourth category is 50% reduction of the restricted amount. There is a long list of institutions which qualify these four categories. So we have seen section 80 under chapter 6, section 80C we had seen, which is your general 1 lakh deductions. Then we saw national pension scheme, which gives you additional 50,000 deduction. Then we saw medical insurance up to 1 lakh rupees you can get if both are senior citizens, children, person and his parents. Then on education loan you get this 80E. Then on donations you get something which is under section 80. Very interesting provision. Sorry, 80GG it should be not 80. Sorry for that. Now, how many of you know this? Most of them do not know this. Assume somebody is a salaried employee, particularly self-employed person. I don't know why I said, but this is what is written. And the salaried person is receiving no HRA and no rent-free allocation. Many cases. Companies do not give HRA rent-free allocation each and every day. But that person is living on rent, the place where he is working. And if he has no house, there the place of work, or his house, or another child, there is no house, then he can get some deduction, which is actual 10% of the adjusted income. Again, something like the restricted income, that's adjusted. Or 25% of the adjusted income. or rupees 5,000 rupees per annum, whichever is least. I'm saying 5,000 rupees is the least amount. Say for example, 5,000 into 12, 60,000 rupees of exemption. Somebody is staying on rent, this should actually be and particularly for self-employed. They are staying on rent. Obviously, there's no HRA, no rent. He can claim 60,000 rupees and his 30% bracket is saying close to 18 to 20% rupees of the total. So this is section 18, which is other deductions. We are all very clearly aware of this. What is section 18A, where every one of us gets up to 10,000 rupees in our interest, only on savings. If you have interest on FDs and all, you will get it. Now, section 18B, which is made for senior citizens, where up to 50,000 rupees you can have deductions. And this also includes not only savings but also interest on fixed deposits. So this is section 18A. Rebates, there is something called section 87A. In the old tax regime, you have up to 2.5 lakhs, no taxes. 2.5 to 5, it is 5%. Now there is provision for giving some rebate. If any person who is above 2.5 lakhs but below 5 lakhs is entitled to get a deduction of 100% of the tax payable, meaning which he will not be paying any taxes till 5 lakhs. This is section 87A. Now, if it is a new tax regime, this 5 lakhs is changed to 7 lakhs. Deductions, exemptions not available in tax regime except employer contribution, which I mentioned towards increase that. There are many restrictions on setting carry forward. So, unless you are very clearly beneficial in choosing the tax regime, just think about it, consult your tax consultant or chartered accountant. So, Shanmugam sir, with this I will close because there is many things to speak, but then let us explore. And so this is what I want to share in this session. Is my screen still?
Yes, sir.
Oh, so, the questions, there's some of the questions I may be able to answer because just please understand I'm also reading like you. It's that I'm a patient, so because of that, I need questions. But I'm not a chartered accountant. So some of the questions you may pose, maybe I'll be able to tell you on beforehand. Some of the questions I may have to cover back some of the questions because I may not be practicing to say I may not be able to tell you. What I've done is, but I'm promising you that whatever question, any kind of tough questions, any deep questions will be answered. If you have some, you can write to me at this my email ID and my mobile number is also there. So, irrespective of whether I'm there, you will definitely get this. So, this is what I do.
Thank you, sir. There are a few questions posted in the chat box.
Can I see them? Can you see them?
Yeah, you can see in the right bottom, or I will read out the questions.
Yeah, that will be very much helpful, but just for learning, I'm trying to do this because I don't get this, but if you can help me also, that will be nice.
You can see the right bottom corner, third icon.
Yeah, chat. If you want to read it, that is what.
There is a question from Anathurai. This question is, what about income from house property? Can we shift from old to new regime whenever we want?
Okay, great. Fine. So, I was going through the rules. It very clearly says if you are a salaried employee, then you are given chance every year. Before before filing your returns, you can prefer where to be and where not to be. So that is very great. Others, it is saying once you do this, I mean, it's not possible to change. That is what I see. I also read this. So if you are salaried, then very clearly you can change.
Thank you, sir. There is another question from same another, right? From NPS, if you withdraw 60% is tax free. You can split 10% every year for 6 years. Can we get an exemption?
This question is a good question because I am also hoping the answer to this. I'll tell you the background of this. You know, earlier there was no such concept SWP under NPS, right? Whatever your superannuation year or retirement year, your supposedly when you reach them, now it is extended 70-75. Now, when you reach them, you are allowed to take the 60% of your accumulated corpus as tax free. The rest is converted to pension, which is taxable in Works Act. Now, recently, they have come with, I mean, I'm not sure, but whether they have published this or it is on the anvil. In that case, you are allowed to, like what we do in mutual fund systematic works like pensions, 10% every year for so many. So these are yet to be seen, sir. Mr. Anadri, what I can do is let me check if SWP in NPS is actually active or consultation papers going on. I'm sorry, I'm checking. I have to check it. But I'm sure that up to 60% of the amount which is freeze, which is calculated based on your corpus at the time of your closure at 60 years, that won't be taxed. That is my understanding. Whether you take it one time or if the SWP provision is there, you are splitting it, that should not be taxed. That is my understanding. Yeah.
The another question also from Mr. Anandre. Question is to get exemption from capital gain tax, we have to invest in 54 EC bond. Entire sale proceeds are only
Capital.
capital.
Right. So let me explain this way. So first section where we saw if you sell a residential house, buy a residential house, only capital gains need to be invested. If you sell an agricultural land, urban land, you are going to buy a new urban land, agricultural land, then again what is the capital gains? Be invested. Now I'll jump to the last one where I said any other capital asset, you sell it and buy a new residential house. Then in that case, entire sale proceeds will have to be invested. Now for section 54 is on whatever capital gain that needs to be invested.
Thank you, sir. I'll move on to another question. Question from Mr. JP Narayanan. Whether we need to declare this non-taxable gift.
Okay. So, that's a fantastic question, sir. This puts me on the spot. Generally, within the family, it gives taxes, it gives. Obviously, it will be more than 50,000 within the family related system. But I tell all my clients to have a gift deed prepared, say 3 lakh rupees, gift deed prepared, and then keep it on record. Question: if it is non-taxable, let me just check the income level. That has to be declared in the exempt income form or something. I'll check that and let you know, sir. I'm not into filing back, so I'm unable to answer this, but I'll definitely know if I can get in touch with you somehow. See, either you report under exempt income category and then get exempted, don't pay taxes. If you're not reporting it, at least have the deeds in place for your record. If there is a question by checking your bank account, this income has come. The AAS gives you all out. You should be able to say this is what the deed I have paid me from this matter, like from my daughter or this. But I'll check.
The next question is from Mr. Chakulingam. Share of income of our member of HUF. Can you please elaborate on the same? How HUF can be made helpful by salary?
Two parts to it.
Yes.
First of all, HUF is a separate tax entity. It is a non-individual. By definition, it is an undivided family which holds properties under its name. Say, for example, a house is there which belongs to the father and the sons. The sons and daughters, they are called co-partners. The HUF gets the rent out of that, right? And now, if say 1 lakh rupee rent is coming into the HUF, all the co-partners have a share in it. Got it? So that 1 lakh rupees belongs to, say, there are 5 co-partners, everybody has about 20,000 as their share of income. Now, why I mentioned this need not be covered with the income of, I think your question probably relates to that state wherein I said, income of the member of HUF and income of the member of a partnership need not be clubbed. Why? Because HUF will also be paying taxes. 2 lakh rupees is the income from property for the HUF. They would have paid all those annual value deduction for 30%. The rest after paying taxes, only they would have, let's say, 1 lakh rupees in the income. That 1 lakh belongs to the member, which is 10%. Your question is share of income. Please elaborate. This is share of income of the member of HUF. Now the second part, how HUF can be made helpful. You are saying my salary, I will need this for salary.
For salary.
Now very clear, sir. You can be a salaried person, but you can also be co-partner in your HUF. You have a HUF, you can be a co-partner in the HUF. Now, by being a co-partner in the HUF is not going to do any reduction in your salary. That's what I said. Every income is totally calculated and then aggregated. Now, why HUF is made then? That's a totally different question. Assume you have, say, 10 lakh rupees income, say 15 lakh rupees income. So 5 lakh rupees income, you pay 30% tax. But somehow, if you're able to shift that 5 lakh rupees of income, what you pay is only 10 lakh, 20% income. The remaining 5 lakh rupees is shifted to the HUF, which is a separate tax entity, on which you pay only, say, 5% taxes. So you need to plan in such a way. But to your question, your salary, having a HUF will help you in some way or other by reducing the salary. That is not good. It can only help by way of your total income can be split between you and your HUF, but you have to plan the rest. So you cannot transfer all to the government just like that. So hope your question you also try to answer.
Yes, it's Muthu Chakuling acknowledge we were replying, sir. Thank you so much. And one final last question, that's from Mr. Rajkumar. For ESPP stock options sold as soon as received from the employer. For sold foreign stock, capital gains are paid as well. Do we still have to show it as a foreign asset as it was held 1 or 2 weeks before it was sold?
Held 1 or 2 weeks before sold. Okay. Fine. So if you're a resident Indian, you are supposed to declare all your global income. Right? So the answer is very clear. You have to show them. But you have paid abroad, whatever foreign, if it is sold in the foreign and you had paid some taxes there. Here, please check whether you have double taxation avoidance agreement with that country. If that is there, then whatever taxes you paid there, you will get as a tax. They also give you a statement. If you look at your software company, other countries and receive salary there, and taxes are deducted there, the tax statement. That can be used as a tax credit for filing your income return. But then if you're a resident Indian, you are supposed to be.
question from Mr. Krishnan Tyagarajan. Is there any limit for percentage dollar bond investment?
Dollar bond, by that, what he means, I mean, he can invest in bonds in US markets. Is that what he means?
Not so clear, sir.
What with dollar, I could have understood it, but he has put in E. That is what is confusing. Or maybe you can take him on line if he's available. Then, if I am able to understand this question, sorry, 54 E.
Okay.
54 EC is talking about, right, sir? Mr. Krishnan? The bonds. Yeah, okay, fair enough. Yes.
Yeah, just wait.
Yeah. He will rejoin. Yes, Subhay, sorry, Subhay. Sir, can you unmute yourself, Subhay, sir?
Yeah, am I audible now?
Yes.
Sorry for that. So I was answering the 54 EC bonds. So there is a limit of 50 lakh rupees. The last question.
Prema Bhai, go ahead and unmute and ask your question.
Good evening, sir. It was really very nice hearing you. Of course, I'm not that good with these stats and all because my family takes it, but still I was very happy.
We are all an engineer, so
very happy, sir. But one general question always has in my mind that I want to ask. It may be very silly or it may be okay, I don't know, but still I would like to clarify this. They always say that the state or the country is very profitable because of the liquor, right? But I've always want this liquor to be totally eradicated so that your families can live in happy and peaceful, because it's a very, very concerned about several issues that we hear. All the root causes because of the liquor which is destroying the families. So can we pay more tax? Can the people can pay tax and do some compensation so that this is not going to grow or this is not totally been removed, so that people can live happily and peacefully? Some way should be there, sir. இது எதுக்குன்னு தெரியல. எல்லாம் சொல்றாங்க அது நின்றுச்சுனாக்கா அப்புறம் நமக்கு அதனாலதான் ஓடுது, அதுதான் பணம், something about this. I don't know what it is all. Can you help me out how to, because I put my quest to Man Ki Baat, that also I have given my audio how to eradicate this one, because it's really troubling many families, especially young engineers who have lost the job or not getting job, or young children are getting into all these issues in family, and parents are so much concerned about this habit. So if we eradicate totally, slowly, like smoking is being stopped, like that, it may then something. Sir, please help me out and understand. Thank you.
Okay, so in terms of your opinion, I share the same opinion, if not more, that this is something which is destroying the soul. But then, people talking, because of taxation, we need to do it. That is an alibi. I mean, we all know there are some states which don't have liquor, some may have small, some may have more. So I think you should not take it very seriously when somebody is saying we need, otherwise the country cannot be run. None of us in the room will agree, because we need to do the cost benefit analysis in society and do it. Now, coming back to the question in relation to taxation, I think we are going in that direction. There is a measure called the tax to GDP ratio. The more it is, the better the country in terms of richness. So I don't have the data right now, but I can assure you, you can be happy about that. Let us not be despondent about it. I think you should be happy that totally, if you look at India many years before now, the tax buoyancy is very clear. Direct taxes, indirect taxes. For after a very long period, in the last couple of years, we're actually exceeding the budgeted receipts. So tax to GDP ratio is going high. So I think good things are, on us. So I completely share your concern in terms of society, but in coming back to our discussion of taxation, we should be happy that we as a country are doing some superb work in terms of tax collections. The number of tax filers, the number of people moving into higher slabs, and the corporates which are paying taxes after the GST introduction. So most of the parallel economy is out. Everybody is paying taxes. So, madam, I would say you be more positive. Like I'm also planning to be. I'm getting positive. So good things will happen to our country. So this is my answer. Thank you.
Thank you, ma'am. I think we have only 7 more minutes. If you have further questions, you can email to Subhaya sir, and you can reach out to him on his mobile. Now we will, I request Natarajan sir to give a concluding remarks on the session, and then we can later on we can close the session.
Thank you, sir. Subhaya sir, thank you for a wonderful session. So as usual and as always, communication is crystal clear. So it is like, as we say in Tamil, first marathon bola. So just so it went inside us. So thank you for that. And Subhaya sir gave good side view, as I said, on taxation and different types of income and how it is computed. Okay, what are the different categories? Okay, and I'm sure he gave all the inside view of the taxation. So he touched upon the capital gains, and he explained beautifully the various options to exempt from the tax. Okay, and especially for the gifts exemption. So those information actually are quite new for many. And how to club various income. And so there are many information. In fact, though I read a lot of things, so they are new to me also. So I'm sure everybody has immensely benefited from this session. And so I'm sure there are 4 other sessions that we completed earlier. So request all the alumni members to watch all entire series and come to conclusion. And they can always contact Subhaya sir for queries or any investment related one or tax exemption, all kind of queries. Thank you, Subhaya sir, and thank you, Shanmu. Have a great
pleasure for hosting this. Thank you so much, and thanks to all the participants. I'm there. You can always get in touch with me in case if you have any. Thank you so much for that.
Thank you, Subhaya sir. Thank you everyone for attending the session. Appreciate your time. Thank you so much.
Thank you.